When most people think about investing in the stock market, there are two questions that come to mind. Number one, what stock do I buy? Number two, when do I buy that stock? So you're thinking, how do I find the next Amazon? And now you might go out and buy a lot of the Amazon stock today because you think that Amazon is going to take over the world, and you take on a lot of risk. If Amazon does succeed and they grow big, you could see your stock price rally and you could get rich. But there's risk because if Amazon does something wrong, they get involved in a bunch of lawsuits and then they start not innovating, they have a bad CEO, they start to manage their cash badly, and then they go bankrupt, well, now you lose everything, and now you did not build that wealth, and you also lost all the money that you invested. That's the risk of picking individual companies, not to mention if you're trying to find an individual stock to buy, you also have to know how to value the stock. You have to understand how to research the financials. You have to know how to study the company. And most people don't want to do that and don't know how to do that. This is where the alternative is to invest into a group of companies called an index. Now, instead of me investing my money into this one stock, I am buying this basket. I buy money into this fund, and this fund might have shares of Amazon, McDonald's, Nvidia, Tesla, Apple, Coca-Cola, and hundreds of other companies to give me diversification. Now I don't have to go out and find each one of these companies. I don't have to research any of the companies. I don't have to keep up with the financials. I just find the right fund to invest in, and I keep investing in it because now if Amazon were to go bankrupt, Amazon will be kicked out of the fund and replaced with another stock, and it's passive on my end, so I don't have to do anything. I don't have to worry about what's happening in the markets. I just keep investing money into this fund because this fund is there to find me the best companies to invest in. And you might say, well, Jaspreet, Amazon's not going to go bankrupt, right? I mean, that's not possible. Well, that's what people said about Sears as well. Sears was the largest retailer in the world, and then they went bankrupt. That's why investing in a fund is an easier way to get started. I'll show you specific funds that you can consider investing in, but not all funds are made the same, which is why I want to discuss ETFs, mutual funds, and index funds. I know this can sound very complicated, but if you stick with me, it'll all make sense. So let me show you what I mean. Index funds, ETFs, and mutual funds are three different types of baskets of stocks that you can invest in. They're all very similar, but they have their nuances, and this might be one of the most valuable charts for you to understand when it comes to understanding investing in these funds. So let's break it down. Index funds are generally passively managed. That means they're generally managed by an algorithm, not a human. Why does that matter? Because when an index fund is managed by an algorithm, your fees are generally lower because you have to pay a fee when you invest your money through a fund. You're paying a fund manager. But when you're paying an algorithm, that fund management fee is generally very low. And with an index fund, you can generally only trade in and out of these funds one time a day. It's not like a stock which you can buy and sell hundreds of times a day. An index fund, you can generally only trade in and out once, and they generally do have a minimum for you to invest. Sometimes you have to invest a minimum of $500 to invest into an index fund, sometimes $1,000, sometimes a few $1,000s, depending on the fund. Let's compare this to a mutual fund. Mutual funds are generally actively managed, not passively managed, which means you have to pay an expensive money manager to pick the best stocks for that fund. Is that good or bad? Well, the goal is to have a money manager who can find better stocks to outperform the general market, but that doesn't always happen. Now, because you're paying for an active money manager, you're also going to have higher fees. This is what makes it more difficult to become more profitable with a mutual fund. Not always, but many times it becomes more difficult to become more profitable because you also have to pay these higher fees through a mutual fund to pay for that money manager to manage a fund. And just like an index fund, you can generally only trade in and out of your mutual fund one time a day. And yes, there are also generally minimums when you invest your money into a mutual fund, because generally you'll have to invest at least a few $100s, if not a few $1,000s, to get exposure to a mutual fund. Let's compare that to an ETF. An ETF stands for an exchange traded fund. This is kind of like a hybrid between index funds and mutual funds because this can be passively or actively managed, because there are many different types of ETFs out there. Then when we look at the fees, it could be low or high depending on the management of the ETF. Passively managed ETFs generally have lower fees. Actively managed ETFs generally have higher fees. But then when you look at trading of ETFs, You can buy and sell an ETF an unlimited number of times a day because an ETF trades just like any other stock. You can open up your stock brokerage app, whatever you use, and generally buy and sell an ETF like you would any other stock ticker. So you find the ticker symbol for an ETF and then you can buy and sell it just like any other stock. And there are generally no minimums when it comes to buying ETFs minus whatever the cost of the ETF is. So if an ETF is trading for $100 a share, you generally only need $100 to buy that ETF, but now with many brokerages, you don't even need the full $100. You can buy fractional shares of an ETF, so there are generally no minimums when you invest your money through an ETF. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.